Welcome to the Economic Times Startup Dialogue, a precursor to the Startup Awards. The dialogues bring to you opinion and analysis on subjects impacting the startup ecosystem. The Economic Times Startup Awards is presented by IDFC First Bank. Thank you for joining us.
Welcome to the Economic Times Startup Dialogue. The dialogue is a precursor to the Economic Times Startup Awards, instituted to celebrate the finest and the bravest who risked everything to launch a new enterprise. The Startup Dialogue highlights opinion and analysis on subjects impacting the startup ecosystem. In the first of the series, we will be discussing the ever-expanding role of Digitech in the financial sector. I take this opportunity to welcome Anurag Thakur, Minister of State for Finance and Corporate Affairs, Government of India, for the keynote address.
Ladies and gentlemen, Namaskar. Thank you for inviting me to deliver the keynote address at the Economic Times Startup Award 2020. The subject I will address you on concerns both the health and stability of the financial system. Before I share my views on which direction the future of banking and financial services will head towards, I would like to stress on few historic reforms and initiatives under Prime Minister Modi leadership and how they will ensure the robustness, expansion and foundational framework for the future of the banking and financial services industry in India. Over the past couple of years, we have announced several public sector bank mergers, which has brought down the number of public sector banks from 27 to 12 currently. These mergers were done strategically and will lead to synergies in geographical presence and benefits of scale and will lead to better management of capital. We have also opened up a record 400 million new Jan Dhan bank accounts, providing financial inclusion and financial security to our rural brothers and sisters, even the poor in the urban areas. Further, we have also laid the digital highway for growth of the banking and financial sector by taking up the task of connecting India's 6 lakh villages with optical fiber network. In the last 5 years, over 1.5 lakh village panchayats have been connected with optical fiber cable. And it is on this digital highway that India's digital payments is setting new benchmarks. We also created UPI Bhim, which many have termed as India's financial soft power. And I'm happy to share that the UPI Bhim crossed 2 billion transactions in the month of October, worth rupees 3.86 lakh crore. We also set up IFSC Gift City in Gujarat. In the last budget, the Honorable FM announced to set up an international bullion exchange and an additional option for trade by global market participants. Last month, the India INX International Exchange achieved the highest ever trading volume of 10 billion US dollars in one day. Recently, we notified that operating lease and financial lease and any hybrid of operating and financial lease of aircraft or helicopter and engines of aircraft or helicopter or any other parts will be treated as financial product under the existing legal framework for IFSCs in the country. Further, we have also brought the Bilateral Netting of Qualified Financial Contracts Act 2020. This law will help banks optimally use or utilize capital and increase credit limits so as to enhance liquidity in the economy. It would free up capital, reduce hedging cost, liquidity needs for banks, primary dealers and other market makers. We also brought the Banking Regulation Amendment Act 2020. This permits the RBI to expand its regulatory control over the cooperative banks in terms of management capital, audit, and liquidation. This again is historic and will go a long way in checking banking frauds and crises, thereby protecting and safeguarding the money and the savings of the depositors. Moving on now to the issue of future of banking and fintech. History has shown that finance is often the first to embrace new technology and connectivity. From desktop to cloud, from internet to social media, from IT services to Internet of Things, we have come a long way in a short time. There is daily disruption in business. The character of the global economy is changing. Technology is defining competitiveness and power in the world, and it is creating boundless opportunities to transform lives. In the last 6 years of Modi government, banking and digital reforms have empowered the weak and brought into mainstream those who were on the margins. It has made economic access more democratic. So today, more than a billion biometric identities, more than a billion bank accounts, more than a billion cell phones give India by far the biggest public infrastructure in the world that is also shaping a billion new dreams. This is an opportunity, a market, and transformation unlike any other country in the world. In the future, perhaps sooner than we imagine, banking will be more intertwined in the lives of consumers than ever before. Accessing banking services anytime, anywhere, without the need to line up and become a reality a few years ago. The notion of banking will be that a smartphone in the palm of your hand for a sizable section of the young, digital, urban, and rural population. Personally, I feel millennials do not like waiting. Perhaps that's the reason they were the first to adopt payment platforms. My father's generation went from passbook to checkbook, while my generation went from checkbook to web banking. The millennials and youth are directly adopting app-based banking solutions and digital payment platforms. And there will be those who skip the traditional banks altogether and open their first account with a fintech platform. What's common about these fintech newcomers? They pick and choose a few banking services, and obviously, they choose the most profitable ones. Unlike the traditional banking system, which offers the full menu of services, this is an era the traditional bank must evaluate in order to compete. This is the era of artificial intelligence. And in the age of artificial intelligence or Atmanirbhar Bharat innovation, big data analytics will help us in efficient risk assessment and management. Along with the fraud detection algorithms, the banks can internally have a better assessment whether to lend to a certain borrower or not. Market analytics will offer a window into the opportunities for the banks on whether they should lend to a particular sector or not. Fintech can help assess NPAs and give insights into trends both sectoral and for the personal banking. In fact, in the India's context, there are 6 great benefits of fintech: access, inclusion, connectivity, ease of living, opportunity, and accountability. Digital payment platforms such as the UPI Bheem have already brought a rural revolution at the local Kirana shop and to the street vendors. In fact, digital payments have also ushered in an era of transparency and timely payments. Traditional banks will have to transform and evolve to keep pace with the digital revolution underway in India. Moving on, banking services will cater to every aspect of our lives. The 2 most important keywords for the future of banking and fintech are trust and security. The customer's trust will be in return for digital and financial security. If banks desire to remain gatekeeper of the funds in the future, they must guarantee sound advice, secure services, resulting in sincere trust. But one thing is clear: Those who earn their customers' trust and deliver timely services will be laughing their way to the bank for sure. Now, that leads me to an important question the innovators in the banking and fintech sector must deal with. Will people looking to invest and manage their assets trust artificial intelligence and virtual advisors? Especially in the Indian context, where we value human interface, will the absence of human touch affect our levels of trust in decision making? While there are those who are willing to take the 2-minute loan that the banking app offers, how many would be willing to invest in schemes simply on the advice of the chatbot or virtual manager? As I've seen during the pandemic time, what my children and how they used to connect with the class teacher with the physical presence, they are unable to do so with the digital classrooms. Now let me come to the personalized offers and financial products. Personalized offers and financial product promotions will be the future and preferred choice. Personalized banking solutions will no longer be the luxury limited to only the urban or wealthy. Under Modi government, we have ensured that the JAM Trinity along with the Digital India has brought financial inclusion for the unbanked. Personalized advisory shall no longer be limited to asset managers. They are already being replaced by chatbots, virtual assistants, artificial intelligence powered apps. The financial services industry will continue to be one of the biggest spenders on technology. Standard customization will change to personal customization. This is good. It will not only lead to better banking services but also cutting edge innovation. Banking jobs that are repetitive, rules based will eventually become artificial based or virtually by the next decade. I don't consider this as job loss, it's a job replacement. They will be replaced by those who can manage these back-end artificial intelligence based solutions, programmers and coders, cloud computing experts, big data analytics, etc. I also foresee the nature of the banking exams changing and the nature of specialized finance MBAs. Core courses like economics and accountancy and finance will have to include an aspect of fintech. The bankers of the future will be very different personalities, skill sets, and roles. The lines between who can provide financial services have blurred globally. It's no longer only the banks. A social media firm, through its messenger, allows you to transfer money. A messaging platform has integrated a payment gateway into their app. A travel app allows you to buy not only a ticket but also a travel and health insurance. An artificial intelligence powered car is updating your insurance company to lower your premium because you drive safely. A food delivery and a shopping app is connecting with your bank to offer you discount coupons and tracking how you spend apart from making you spend more. So they are keeping a track on you. An e-commerce firm has given student loans and even launched a market fund. Artificial intelligence powered chatbots that mimic human responses are looking to replace the customer service and the customer care call centers in the future. We may trust them with number crunching. Will the consumer trust them with financial investments? That I leave it to you. We have transitioned from thumb imprints and stamping to signatures. Today, the traditional signature is being replaced by digital fingerprints, biometric voice recognition based platforms that are emerging as frontline of digital security in the banking industry. Is the encryption foolproof or can their firewall still be breached? Again, This is a question for the fintech innovators to answer. Ease of doing business has brought ease of digital payments, which has given ease of living. But we also want ease of customer claims, and ease of redressal of complaints. This is crucial element in winning trust. And there is no better publicity than a word of mouth positivity. Let me end by saying I would like to take the opportunity to appreciate the work of bankers and financial system as a whole. I would also like to acknowledge and applaud each and every member of the banking fraternity who has kept the system efficiently running during the COVID-19 pandemic. You have ensured the robustness of our financial system and liquidity in the market. Let me also congratulate each and every one of the winners and innovators being awarded at the Economic Times Startup Awards 2020. Jai Hind, Jai Bharat.
Thank you, Anurag Thakur, for the insightful keynote address. I will now request Samida Sharma to take the panel discussion forward.
Hello and thank you very much for joining us here today. And so we're kicking off today what is the first edition of the Economic Times Startup Awards Dialogues. This is in the run-up to the grand ceremony, which we will be hosting very soon, virtually, of course, to felicitate all our deserving winners of this year's Startup Awards. We wanted to kick off with a very interesting and eclectic set of panelists that we have here to discuss the ever-changing landscape in the fintech and the overall digital payments and banking sector. We're going to be discussing how digital technology would power the future of banking and financial services in India. And joining me today is four of veterans and leaders in their own in their own spaces. Samir Nigam, who is the co-founder and CEO of PhonePe. Madhur Dera, President Paytm. There's Rajiv Ahuja, who's Executive Director at RBL Bank, and Lizzie Chapman, who is the co-founder and CEO of Zest Money. All of you guys, thanks. We're experimenting with this format to just create a little bit of buzz around what has come about to become a very prestigious recognition in the startup and entrepreneurial ecosystem, the Economic Times Startup Awards. This year, unfortunately, we've not been able to hold the event like many of you would know, but we wanted to discuss a few things which are important to the ecosystem. And as you all know, digital payments and fintech is absolutely at the center stage of that. So I don't want to waste any more time. I want to start off, by getting each one of you to give us your viewpoint on the multiple, regulatory changes, the launch of, WhatsApp and what happens to UPI sort of going forward. Amid all of the regulatory policy changes and the adoption of digital payments, and thanks to COVID, I mean, like Lizzie was mentioning, it has been a complete positive for the industry. Tell me, what is the, how does all of this sort of change the dynamics of the industry? And Samir, you want to start by giving us, your viewpoint on all of the changes and the regulatory landscape amid the fierce competitiveness in the industry right now?
Sure. Thanks, Amida. I guess COVID just created such another artificial sort of boost for digital payments and digital banking overall as well, right? I think what's really happened is you're seeing unprecedented amount of new consumer trial as well as a lot of systemic issues propping up in terms of scale, outages. I mean, there's articles every day, right? Volumes on UPI doubling at a massive base, going from 1 billion transactions a month to 2 billion in the span of 4 months. I mean, that's just not normal. So I think what's happening is, one, digital payments is in fact growing because of a lot of regulatory changes over the last 3 or 4 years. They have enabled one of the fiercest competitive environments I've seen in any industry. And I think we've seen this in telecom in the early 2000s, where suddenly, like, license on tap, everyone can play. And I think, again, we are starting to hear rumors of the regulator talking about banking licenses on tap, or finally for like new business houses, new age companies, payment banks being able to get a small finance banking license in 3 years, not 5. I think the licensing regime is getting more relaxed, which means there's more competition coming up, which in general is really awesome. I think one small change that came through during COVID, which went rather sort of wasn't talked about much, was the fact that the regulator said the licenses are now permanent. You don't need 3-year renewals on your wallets and your PBPOU license and so on. And I think that's a big relief, especially for early stage companies, because when you're new to the regulatory landscape, that's another sort of news that's just hanging. And okay, I have a renewal coming up. So I think we're moving towards digital, quote unquote, digital or fintech becoming mainstream. And I think the regulator's starting to treat us as such. More regulation, more oversight, but more rights.
You spoke about the very recent recommendations that have come up from the RBI's internal working group. And, it's sort of a hot button issue right now. Rajiv, you want to talk about, what that would mean if industrial houses and conglomerates are open to being handed over banking licenses. What is the kind of, changes that you foresee as an incumbent?
Yeah, so Samita, I think there are many aspects to this which are not being fully fleshed out. So I think I'd say the whole governance around the financial and the non-financial business of a conglomerate needs to be understood and addressed. The supervisory function of the RBI, which they themselves, as part of their recommendations, needs to be strengthened so that the risks emanating from the non-financial business do not seep into the financial business. So a lot of work required, but I think there's one recognition throughout this working document. I mean, we can keep arguing about each small point, but the one recognition is that the Indian banking industry gradually and now fairly quickly has to be enlarged. We've had, the 2013 two universal banks, then about 7-8 small finance banks and a few payment banks come out a little later. I think if you take a 10-year view, India will need much more banking capacity, a lot more banking capital. And I think the regulator and the market at large is sensing that you need better and better structured, better capitalized, and more modern, business model oriented banks. So whether the conglomerates get a license now, later, what the rules are, I think if you took a 3-5 year view, a lot of these things will actually get implemented in some fashion. So, which is good for the system because, few of us cannot just sit down and say it's all hunky dory. Fact is, India is still tremendously underserviced. I mean, we've done a lot in technology. We've done a lot because of the JAM initiative, but a lot of India is underserviced. And actually, banking is a vertical in India where supply begets demand. So if you have good supply, I think the demand will come in, and that itself will lead to a second, third round of requirements. So I see this as positive, notwithstanding, issues around point A, B, C. The fact that they've allowed larger stakes being held by promoters and by non-promoters is an admission that this is not a segment that can be financed by by generally only retail. It has to have deeper pockets. So I think that's a step in the right direction as far as I'm concerned, Smita.
Madhur, I mean, you can talk a little about specifically Payments Bank. I mean, Paytm has a presence there. You can now sort of instead of 5, you have 3 years to sort of apply and become a small finance bank. It's not been a great success by any stretch of imagination. The entire experiment around Payments Bank per se. what are you making of the landscape that's sort of changing in terms of more regulation? And like Samir mentioned, and we keep having this conversation that more and more unregulated entities and segments within fintech would come under the ambit of regulations. What do you make of it as a very key player in the fintech space? Paytm has seen sort of from the wallet stage to UPI payments bank. How are you sort of navigating through all of this? If you can take us through a little bit of that.
Yeah, thanks, Amita, for having me on the panel. Excited to be here. Listen, put aside for a few minutes today, put aside COVID and put aside, what happened in the last 6 months or what's going to happen in the next 6 months. It's a very interesting time to be alive. It's a very interesting time for a lot of us to be in the prime of our working careers. I mean, if you just take a step back, about 7-8 years ago, we had this bet and this conviction that payments is going to come at the forefront of consumer interactions, right? And not just in the fintech space, just overall in consumer internet, right? That payments is not going to be one of the things which is an afterthought when you're doing something. It is going to be the forefront B2C journey between consumers and merchants, because that's an important one to solve. So that's the first insight. And the second one was that on top of the payments layer, you can build not just fintech, but also consumer internet, right? So fintech and consumer internet will become layers on top. And over the last 5 to 7 years, that's playing out. And it's not just playing out, it's playing out at an accelerated pace, right? Which is the true true proof of how strong an idea that is, right? That as we build bigger and bigger, there are bigger and bigger opportunities ahead of us, and there are faster growth opportunities in front of us. To the specific point of regulation, when we applied for Payments Bank, I clearly remember this. There was some debate, like there should be. But one of the sort of big principles of that was that if we want to have as much impact, and as a company, we're very ambitious about what we want to achieve in payments, financial services, consumer internet, merchant services, and so on, the regulator will, if you want to have that big impact, the regulator will have an interest in knowing what's going on, right, in your systems. If you're going to have 500 million customers, you're going to have 20 million merchants, if you're going to provide them payments, not just payment offering, but lending, deposits, insurance, wealth management, and so on, the regulator will have an interest, right? You may get some, licenses. There might be some experimentation. There might be some, which in other countries they would call sandboxes. But eventually, the regulator will have an interest in whether 500 million people's money is being kept safely. Are they getting products that you're telling them they should be expecting? KYC, AML, money laundering, all of those things will be something that the regulator will pay an interest in. So that was kind of the big principle through which sort of got us to apply for the Payments Bank license. That if you want to have big impact, you need to sort of get yourself readied up anyway to do regulated businesses long term, right? On Payments Bank, at least our experience has been different. The premise of your question was Payments Bank have not been successful. We believe that Payments Bank has been very successful for us in two ways, right? In two main ways. One is that there's 60 million customers, 60 million customers who have opened Payments Bank accounts with us, right? And over 45 to 50% of them are active every single month, right? So I'm not talking about just getting a deposit, but actually using that payment bank to do some kind of transaction, right? So paying somebody either using UPI or using the debit card or coming to our app and making a money transfer. So 60 million customers in a period of 3 years, right? And 45 to 50% of them being actively using that account, I would say has been a success, right? And it's very early days, for example, video KYC to open a new payment bank account only came in India 6 months ago. Until then, 100% of our KYC was face-to-face. So now that this has been a bit of a success, there are multiple enabling layers that are getting built on top of that, which again could accelerate this innovation and this experiment. And the second thing I would say is that it allows us to provide a better customer experience, for example, for payments, for example, for lending, for example, for KYC, right? To give you an example, just a couple of days ago, I think Economic Times only reported this. that there was a failure rate of different payments banks, right? Now, of course, we work with all banks, right? So if you're using Paytm, UPI on Paytm, for example, or debit card on Paytm, you can use an instrument issued by any bank, right? But specifically to UPI transactions, Paytm Payments Bank had the lowest failure rate of any bank in the country, right? Now, that kind of innovation is useful to have infrastructure being built, of course, in the regulated world by a technology company, which allows UPI transactions to operate at the lowest failure rate in the industry and create a new benchmark for it, right? And we would obviously love it if all banks can start moving towards that rate. And of course, if we can continue to do a better job. So I think building regulated financial services, I'm not saying companies should be regulated just for the sake of it, but if you're having large impact, then building that in the regulated framework so that the regulator has this general comfort with what's happening to customers and merchants and on the platform, that's not such a bad thing, right? As the regulator is more comfortable, they will also push you for more innovation, and that is a core part of our journey.
Lizzie, you want to come in and talk a little about the credit and the lending piece that's sort of integral to what you do, and talk us through how. I mean, you mentioned it's been an extremely busy time for you guys in terms of the sheer volumes that you've done. Tell me a little about consumer lending and what is the kind of digital innovation that is the potential to kind of instill confidence in the credit, market. I mean, it's gone through multiple debacles over the last couple of years. There is a lot of, it's extremely low on confidence. What are you doing to kind of get consumers to kind of come back? And what's the uptick that you've seen, which you just mentioned over the last 8 months or so in your business?
Sure. No, and I think Rajiv actually put it very well. Despite all the advancements we've seen in the last few years, especially in payments and deep penetration of banking products, we are still a deeply underpenetrated credit user, right, in this country. Whatever way you cut the data, there is an absolutely, a huge way to go to get to genuine mass market credit adoption in this country. And what we think, and a lot of fintechs share the view, is that the traditional products, such as credit card and personal loan, are not the right way.
Samir, I wanted to come back to you. You briefly mentioned how UPI sort of led the path in terms of digital payments and the sheer adoption and the massive surge of numbers, the transactions we've seen over the last 6-8 months particularly. But also there are multiple challenges now with, and someone mentioned earlier, about transaction failures happening a lot more on UPI. There is obviously a new regulation which is going to be capping market share. All of that really impacts a player like you. What do you make of it going forward?
Any regulation for any player in the market impacts them in some way or the other. I think the market cap one, to be honest, worries me less, because at least for existing players, it's deferred out by a couple of years, and in India, a couple of years is a lifetime. So that worries me less. I'm
surprised you said that, because there are a lot of people who are telling me that they're watching very keenly the entire UPI ecosystem, because that seems like what was wallet a few years ago, and there will be a lot of disruption in that space, especially with WhatsApp coming.
Realistically, right, and Mother has obviously seen the journey more closer than I have on the wallet side. When the wallets were exploding, even then there was talk about market consolidation risk, etc. But I think there was a time when Paytm was almost maybe 80% of the market. And similarly, if I take banking, 150 years in, SBI is still 50% of the customer base and UPI volumes. So, I mean, we have this discussion ongoing with NPCI all the time. It's, what are you solving for? If you're solving for concentration risk at the 3PAP layer, I'd contend that it's actually more important to solve it at the issuing bank layer, because that's where the outages are happening. Data's consistently showing it's not the application layer, it's the issuing side. Second, if you're solving for players monopolizing it because of other external variables, like just dominant user base, existing dominant user base, capital, cashback, whatever it is. I think the market will play out. And what I meant by my comment was, I think the market 2.5, 3 years later will perhaps look nothing like it does today. And 3 years ago, also on UPI, it looked nothing like it does today. Right? It's been changing every year practically. And the fact that the market share is changing that frequently is testament to the fact that the system is vibrant. If I look at the top 4 or 5 players right now, like Amazon Pay snuck in the top 4, I believe, right now. They were not on the map for the last 4 years. They were playing a wallet play. WhatsApp is just launching. So there are new players coming in. I think I generally I don't have a problem on the cap side as much as I have a problem with things like zero MDR. I don't like zero MDR because it makes it unviable for a new startup like a PhonePe of tomorrow or a Paytm of tomorrow to enter and be viable all the way till it can get to the top. You just can't take $1 billion punt every time and say someone's going to invest so deep to then start making money. That's unnatural. I dare say if we knew that UPI has a zero MDR model when we were starting out, that our VCs would not have backed us. It just is unnatural. I think that's a problem. I think given that 10, 15 million Indians are adopting digital payments every month for the first time, success rates are imperative. That's the focus. So we should be talking about systemic risk in terms of BCP and uptime. I really welcome, by the way, there's again, little innocuous circular, but very important one that allowed wallets and payment aggregators to work with multiple escrows across banks for the first time. We saw the horrors of that when our sponsor bank went down in March earlier this year. We had 75 million customers, money locked in an escrow account, and they couldn't access it. That is ridiculous. So I love the fact that the regulator's taken a very, very progressive view. And I think we're learning together, right? I mean, it's easy to actually say that all the regulation should be perfect and all the market sort of forces should be defined well up front. Fact of the matter is, this is the only way it'll work. When there's this much interest in the market will evolve. I'm just happy that the regulator's moving as fast as they are as well. And not just RBI. We're working with the government on things like KYC Setu. There's a real need after the Supreme Court judgment to find an alternative to digital KYC. As Madhur said, video KYC is transformative in their space. Even for conventional retail banks, you need to find digital KYC alternatives. You need to find them for insurers. You need to find them for mutual funds. So I think we're moving in the right direction. I think regulation is moving in the right direction. I think on the governance side, they're becoming a little more prescriptive. And again, to be fair, that's because I think the tech industry doesn't like being governed well. We don't like having rules. Yeah. I mean, I come from that industry for the last 20 years. Yeah. So yes, you'll hear more grumbling than ever, but it's probably the right thing.
You know, Rajiv, I want you to talk a little about what, Sameer just mentioned. And we saw what happened over the weekend with HDFC Bank. This is the second time. And now the RBI has asked for an explanation in terms of why, the bank is facing these, tech issues. What do you see? You're a traditional banker. What is the adoption of, and how is the adoption of digital payments, etc.? How are you dealing with the surge? How important is all of this to a bank like yours?
So Samita, I think outside of the events of the weekend, and we obviously don't know exactly what happened. It can be impacting anybody as a provider of service. I think clearly one of the lessons, which I think Sameer also talks about, is that we need to have multiple players in the market because, we have, at the end of the day, some of us have had a refresh on our technology very recently. Some people have had longer, vintage, and, volumes have just gone up dramatically in the last 6-9 months. I can tell you that we started our move to the cloud on many of our applications. Today, we have almost 80 to 90 applications on the cloud a year and a half ago. If we hadn't done that, I think the last 6 months would have been very, very problematic for us. So all of us are adjusting to a new reality, a new market where the slope of the curve is very high. And it's also a fact that many institutions with longer vintages. So it's not just a kind of preserve of banks. Banks are always kind of looked as traditional, but there are also a lot of traditional tech companies which have outages, and actually have data thefts. I mean, we've seen many more of that happen in tech companies and so-called new age retail companies. So I think it's important that we all now not just point fingers and say you are new and I'm old and vice versa. Just recognize that this is a very important element in the expansion of the market, that customers need to feel comfortable and confident of dealing with us from a mobile phone or an app, etc. And therefore, the investments we make in technology infrastructure, the partnership APIs, the data security and use of data as well. I mean, these things now actually take a lot of our attention and time, as any institution should. So it's not just a bank or a non-bank. So I think these are things which are going to happen on the approach road to more and more digital consumption. I don't think anybody can stand up and say, we are proof, 100% proof from all this. It's not possible. We just have to continue doing it. And more importantly, the system should function. I think that's very important, that the system should not have one choke point, issuance side or on the control side or on the infrastructure side. And I think those are very important things, because individual institutions or providers will have a problem off and on. And some of that may be linked to, mobile connectivity.
Right.
How do you ensure that for the system as a whole, this does not become a downtime for the entire digital? That could be more disastrous than one institution having a problem. So we've been investing in anticipation, but I can tell you nothing has prepared us for the level of take-up which we've seen in the last 6 months. So we are scrambling now to continue investing. Yeah. And our anticipation is that this slope will continue being at a sharp degree. It won't revert. And actually, as long as many of us continue investing in this, that the consumption will continue increasing.
Right. Lizzie, if you can, come in and talk a little about the lending and the credit space. Now, that's again, there have been multiple events over the last couple of years, which has led to a lot of stress in that segment. You were talking about how, in fact, COVID has been a great positive for your business. How are you sort of instilling that confidence? What are you making of the entire regulatory landscape and the business aside? If you can just take us through that.
Sure. Yeah. And actually, it's a very pertinent point at the moment, especially with the backdrop of this discussion of UPI and payments penetration and success that we've had. Credit is severely lagging, right? Whatever way you look at the data, we have less than 30 million households in this country who have access to formalized consumer credit in any format. And despite the kind of plethora of fintech stories and fintech startups you've been hearing about in the last few years, it's frankly a drop in the ocean. The type of volumes that we're collectively doing to service any type of customer demographic in this country is minuscule versus the size of demand. And so I think what we are seeing is a lot of great product innovation, some really fantastic bank tech partnerships coming up, but really we need a much bigger concerted effort to push that last mile credit distribution in a completely digital way. Now, COVID was a huge boom, I think, across the board. What we experienced was a lot of the bank and NBFC partners that we work with had typically seen their technology or fintech partnerships as an acquisition route, right? It was a way to acquire customers cheaply, efficiently, do a digital sign up. But what then happened was the customer on the back end had a very traditional experience of lending. It was still, paper-based processes, servicing based on, physical or phone call, and collections based on cash and feet on street, right? And what COVID has done brilliantly is a great wake-up call to the entire industry that actually we need to automate everything, right? KYC is just, the first step in a large and complex product journey. And so we see a lot of potential now for much deeper partnerships between banks and technology companies to genuinely build the right products for this digital ecosystem, and a regulator that's actually very understanding of that. So I think what you get from the RBI is a deep understanding of the world and what worked and didn't work in other markets. And you only have to look at, say, the Ant Financial IPO to understand the challenges of ambiguity. If you leave gray areas in a credit regulatory regime, it eventually will hurt players in that. And one of the lovely things about the framework we operate in is it's very black and white. Everybody knows who can do what. And that leads to actually a great delineation in these partnerships. Bank does X, tech does Y. And I think what that means is we will actually be able to scale more stably, albeit slowly, but more stably than in many other markets where regulators almost pitted technology against the bank when it came to credit. And that's not a sustainable, stable, and frankly, consumer-friendly way of building the ecosystem. So yeah, we're having a great time. And I think a lot of buy now, pay later, or any form of contextual credit providers are seeing huge surge in volumes. Obviously, some of it is just pick up from the fact that credit card issuance is down. Physical form factors for what we do, like, you know, the typical EMI providers in store with an agent-driven model have pulled back given the environment. And so there's just a huge kind of macro surge into digital pay later products right now. But we all mostly do that with the backing of deep bank partnerships. And for all of us to scale, we need that ecosystem to scale with us.
You know, taking from that point about partnerships, Madhur, you know, I want to get you on you know, something which a lot of people in the industry are talking about. If you look at a Paytm and you know, you have all kinds of services. You know, you have a wallet, you're present on UPI, you're in the financial services space. You are now basically you know, sort of along with commerce. I mean, and so how do you sort of look at competition which is coming through from global players, whether it is Google, Amazon, and now obviously the Reliance definitely wants to be in this space. There is massive competition, and it's all coming from big tech companies. So what's the road ahead for an independent player like you?
Now, listen, I want to pull on a couple of points, right? One is clearly India is the last big internet market in the world. So it's not the next big, it's the last big internet market. So clearly there'll be competition. It will draw interest from all sorts of players, right? Global players, Indian players, and so on. So clearly it was clear not today, it was clear many years ago that India will be a heavily competed market. We've seen that in e-commerce. We've seen that in the way social media companies and others come into the market, and you know, fintech, especially payments, will not be any different in terms of drawing interest from others. What I will say to the earlier point about partnerships and so on is that I did want to touch upon partnership and regulations, right? Which is the pace of change in technology in general, and especially in financial technology globally, including in India, is at the fastest it's ever been, and it will only accelerate, right? So I think the differentiator between companies that will be successful and that won't be successful are people who do not expect things to remain the same, right? So who are ready for partnerships to evolve, regulations to evolve, and frankly, technology to evolve. Not to mention consumer preferences. So I think it's getting ready for that pace of change, which is very important. Coming back to your point about foreign competition, you know, technology curves globally require, listen, I have a lot of customers, can I sell them the next big thing, right? And that usually doesn't happen. If that happened, you remember 20 years ago, Microsoft had more customers than any company in the world, yet there's a Google. And then Google had more customers than any company in the world, yet there's a Facebook. And then you could say Facebook, yet there's a WhatsApp. So companies struggle to win the next big thing. Now, the one thing which is very successful in winning the next big thing is doing anti-competitive things, which in India, they're going to clamp down on pretty hard. At least that's the direction that we seem to be going in, right? And that was perhaps part of the reason why Microsoft could not win the next big thing. So I think as long as there's a level playing field, Indian companies, especially companies like us, have more than a fair shot of winning the next big thing, right? The one other advantage that we have, like I was saying earlier, of course, we have to be good at technology. We have to build great products for consumers and merchants. We have to take care of our consumers and merchants really well. We have to think about innovation. But the one other thing that we do think is a huge differentiator for us, especially against foreign companies, is our willingness to be regulated when we need to be. And the when we need to be is sort of defined, at least internally at Paytm, as when it can provide the consumer or merchant a better offering. So if we believe that by being regulated, we can give better success rates, we can give a faster loan decision, we can give a better wealth management product, then we will get ourselves ready to be a regulated entity in that area so that we can provide that better consumer experience, right, or merchant experience. And that is critical, and in some ways that's a critical differentiator, because I don't expect that every technology company, especially foreign technology companies, are going to be willing to do that, right? Because it is complicated to be regulated in many different countries. But for us, this is the home market, and we've seen that with Payments Bank. We're also a regulated insurance broker. We are a regulated wealth management firm, and so on. So my suggestion to most startups that we talk to, and this is really become part of the Paytm's DNA over the last few years, is that you cannot run away from regulation. You cannot complain about regulation and say, hey, why should this activity be regulated? Right? If you're going to become large, regulator will have an interest, and you just better be ready for it.
Sameer, you've obviously, I think you want to comment on that point, because just very recently, I mean, it's still sort of ongoing, the tussle between the startup ecosystem and many founders, and what they make of, the sort of powerful, technology majors like Google and Apple. And Madhur referenced to it right now in terms of, the regulatory framework that, countries have, and local players would tend to sort of adhere to those more than, international, technology majors like Google, Apple, and Facebook. What is your point of view? I want to get you on it, and Lizzie as well.
So I think over the last 30, 40 years, any industry where any sector that the technology industry decides to disrupt, it has successfully disrupted, right? That's just nature of innovation. It's happened pretty much every sphere of our life: content, ticketing, movies, commerce, everything. I think what makes the payments and financial services sector different, and what makes India different, are two macro trends, and just happen to be timing is the perfect storm. One, in almost every other sector, we've talked about the fact that a lot of our unicorns and a lot of our big internet companies are Me Too models of what's happened out west or east. That's because those models started 20, 25 years ago out west or east. Fintech's time has come now globally at the same time. So the rules are actually being defined. The products are getting created, in fact, in India in many cases. Like, I can say with some pride that I think GPay has actually copied every single integration of feature. We haven't taken it west. I know that group and we laugh about it, right? They're trying to replicate UPI in different countries. I think that's pretty commendable. But what it means is the regulators and the government don't have a ready playbook to look at and reference and say, this is how other markets solve for it. So that's why they're also actually acting in real time along with the industry. It's the perfect storm, right? If you think about it, do you need multiple NUEs or do you need BCP for one network in the country? China went one way, the US has gone another. In fact, the US has not even managed to introduce something like a PSD2. Europe went the whole hog. So every market's thinking about it differently, both in terms of the technology advancement and the regulatory aspects concurrently. This has never happened before if you think about it. E-commerce laws, Amazon had a 15-year tax waiver. They were fighting over patents like one-click payments. Who the hell cared? 25 years later, nobody cares. You're on a different form factor. But those are the big wars. I mean, you had so much time to react. Now the government and the policymakers are reacting as fast as technology is moving. It's sometimes feel like a losing battle, but they're reacting very fast. And we should actually applaud them for it. The second thing that makes this very interesting as timelines go is that the only force that has ever hurt technology advancement is politics. whether it was Microsoft, whether it is any other antitrust movement over the last 20, 30 years in governments, you take Ant right now. Typically, if a particular company or a set of companies becomes more powerful than the governments that regulate them or the markets they operate in, you generally see a correction, right? And I think that's happening for big tech. I don't think it's India versus foreign. Just so happens that most of these big companies aren't Indian yet, but it'll happen for Indian companies as well. But on that, very quickly, if you see the other flashpoint is not payments or fintech, which are regulated, it's news and specifically social media. The biggest percentage of time allocated during the US Senate hearings right now was around whether Facebook and Google were allowing people to influence elections. Nobody cared about the fact that science has gone out the window. We're teaching people all sorts of distorted data. It's actually about elections. It's that visceral, right? A reaction from government saying, hey, my job's on the line. You are controlling my destiny. So when those two things are happening, especially in a market like India, again, 500 million people are accessing the internet and having a point of view for the first time in history. They're not dependent on Doordarshan anymore. They're speaking up. It's perfect chaos right now in a wonderful way. So I don't think anyone can crystal ball gaze and say we know what the market's going to look like 5 years out, but it will look very, very different and at an unprecedented rate of change. It's a good time to be alive.
Lizzie, what do you make of this entire debate around big tech and Indian startups and whatever was while we were discussing how whether Google will be abiding by the rules of the land of in India. What do you make as a startup entrepreneur? Because at some level, all startups have some competition with an Amazon, Google, or Facebook.
Reflect from a credit perspective, right? So let me give you that side of the story. Credit's unique and it's unlike payments in that the benefits of scale are not necessarily positive, right? If you grow credit too quickly and issue to too many people without building sufficient risk and collections infrastructure, you can lose a lot of money. And so for that reason, it's never winner takes all. You never get monopolistic credit providers. Nowhere in the world, actually, even in China, which is always the exception to the rule. If it was that simple, already we would have seen one of the homegrown payment apps dominate the market. And that hasn't happened yet because it's so challenging and so unique. I think, the other thing always people say is, well, they own the customer, so therefore they can do X, Y, Z. Again, credit doesn't work like that. Owning the customer doesn't give you an automatic right to lend to them, and more importantly, to collect from them. A brilliant example I always use is look at Croma, right? It's a Tata business. Tata have Tata Capital. But what is the biggest finance provider in Croma who does, 60% of all financing? It's a company called Bajaj, who has no relation, because they are the best at that type of financing in that physical store. So in credit, owning the customer and being the distribution manager is just one tiny piece of the puzzle. And therefore, it's very unlikely that one of these giants will become this, credit monster. And frankly, I don't think they have the appetite. Actually, to Madhu's point, it's again back to regulation. And do they really, really, have the appetite and the sort of hands dirty approach? What they are doing, though, and have always done, is control, the gatekeeper, right? Be the sort of customer access point. What we've decided to do to react to that, I guess, is to really try and use their desperation to build the market to help our business. And the beautiful thing is that now we can collect money 24/7 for free with cashback provided by these guys. Thank you, Samir. Thank you, Madhu. And it's phenomenal. It's a brilliant way to build a cheap ecosystem of credit for normal people. So we're trying to be frenemies, is that the word? Basically make friends with as many people as possible and assume that in the long run, the market will be so complex, so diverse, and so idiosyncratic that there is room enough for everybody to play. I mean, honestly, even if Samir or Madhu today said we want to lend to every single customer on our platform, there isn't enough capital in the country for that to be a feasible reality, let alone collections agents and risk underwriting models. So I think that's the beauty of credit. It really is a very idiosyncratic business.
Right. Rajiv, I want you to talk a little about, I mean, while we talk of big tech, they're also trying to get into the space, when it comes to having NUEs, and they've shown interest. They want a seat at the table. I guess it gives them some policy clout. I mean, while Madhur and Samir talk about how, some of these big tech giants would not be able to sort of regulate themselves the way Indian companies do. What do you make of an NPCI rival in some of these NUEs, which have obviously it's generated a lot of interest, not only with tech majors but also Indian conglomerates and groups. And was this really needed? Was this required at a time like this?
Samita, there's an old saying in India, whenever there's licenses being given out, that's always at a premium. So Indians love licensed industries. I mean, at the end of the day, I think, we have to understand that, on more serious note, there is room for a few more players. Now, that could be one or two, because India is still tremendously, tremendously underserved, as I've been saying. You need more innovation. I mean, NPCI has done a tremendous job over the last 10 years. And, they've really, really whet the market's appetite, whet the customer's appetite. You could do with more. And there's many areas, small businesses, financial inclusion, cross-border, supply chain, many areas which are still untouched from a digitization perspective. What we've seen is obviously the core rails, a very consumer-centric business, which is always important to start with. But I think there's more and more innovation. So I don't see an issue. And I also don't think this is an easy way to print money. At the end of the day, interoperability, as people have seen over the last 6-7 years, every time an innovation license is given, the regulators are very clear that it's to be interoperable, it cannot be an island, and the cost of serving has to come down. So if Samir is crying about zero MDR, it's going to be applicable everywhere. And if at all, I think the new NEU is coming, it'll bring down the cost even further, or force the cost to come down even further. So I don't see this as a huge issue. Obviously, in certain businesses, where liquidity gravitates, like the stock exchange businesses, there I think, it has been demonstrated that you have one person controlling a large share. I think payments and extension of payments have a lot of room to grow. And I don't see that as an issue. Obviously, they have to be careful about the composition of the core investors. This is not a 3-5 year game. This is easily a 10-year game. And then they'll have to have the same governance requirements as Madhur was mentioning, that are you serving the community at large? Are you serving the people who do not get access to these services? And are you interoperable with everything around you? And I don't see an issue. I know there's lots of emotions around it, but like many things in India, 3-4 weeks pass and the emotions kind of get back to reality.
So I have a couple of more questions, and then we'll wrap up. I obviously wanted to get you guys to talk a little about, while we spoke about, the massive surge in digital payments and how sort of UPI has led the charge, when it comes to adoption. There's also a big challenge that the industry faces in terms of frauds and scams. In fact, we had a investigative piece today done by my colleagues Ashwin and Anandi, which spoke about how there's been a massive uptick in terms of the number of small towns that have emerged as centers of these kind of scams, and all of these are college-going youngsters. What kind of digital, innovation or tech innovation can really help in terms of financial education and giving confidence to bring the next set of users to transact online, to make purchases. I think this is something relevant for all the four of you. I mean, I know between Samir, Madhur, Lizzie, Rajiv, I mean, we all talk about, how all of you are grappling with this, but this is at the center, at the core of really, getting into the next phase of users coming on board. How are we tackling this issue?
No, listen, we've been fighting this for years. TRAI is supposed to have telecom operator is supposed to have a DND list. You're not allowed to send SMS to people who aren't DND. And yet then not only are there fraud SMSs sent, phishing messages, they're also sent with your company's name in it. And we've been fighting it for years. And finally, there was a judgment recently saying that companies are responsible for it. It was not a popular fight. It's not something that we wish we were fighting alone. Right? We wish that there's a large number of stakeholders that we wish had joined us in this. But it was important enough for us that we actually pretty much went alone to try to get this changed. And people thought, hey, this is some Paytm battle. But it's actually an industry-wide issue. It's actually not an industry-wide. It's actually bigger than this, right? This is a community-wide issue that if you don't have trust in these digital platforms, you're not going to adopt this. And remember, this is dealing with people's money. Right? This is not like one, cab ride gone wrong. This is not one, e-commerce delivery gone wrong. This is like dealing with people's monies and livelihoods and so on, right? So as you're building this infrastructure, it is important that people have that education, right? And if done right, India actually has one of the most secure payments platforms in the world, right? So there's OTP, there's chip and pin, there's UPI pin, and all of that stuff, right?
Yeah.
And especially if done right in the mobile sort of payments world, there's a lot of technology that you can put behind the scenes as well to just make sure that you are trying to do as good a job as you possibly can about detecting fraud rates and so on, right? It's actually, there's more sophistication you can build in than you could in the traditional world or, with cash or with even physical cards and so on. So there's a lot more that you can do. But the industry has to come together to say, okay, there are a few things that we will absolutely focus on. So one is, consumer education, just things like don't share your password, set a password, set a reasonably strong password, and don't share your password. Most importantly, don't share your OTP, right? And and communicating to people that nobody usually calls and asks for an OTP. But then I think there's a lot of work done at a telecom level and so on as well, just to make sure these kinds of phishing attacks don't happen. Reality is a large number of people who use mobile payments, especially payments platforms like UPI and so on, until recently, were the same people who were comfortable using debit cards, right? So we were solving for the same people who said, I don't mind having an instrument linked to my bank account, and I use that as a debit card. Now I will have another instrument, this time a virtual instrument, linked to my bank account, call it UPI handle, right? The real challenge is how do you take it beyond that base, right? And when I say beyond, I mean dramatically beyond that base, right? People who have not used digital payments in the past, and when I say digital payments, I include debit card in that, right? So people who are moving from cash to digital payments is a whole different challenge, right? So I think there are layers of technology literacy, there are layers of financial literacy, and there are layers of specifically within technology literacy, like security literacy, which we need to solve for. And if we solve for that, then financial inclusion is something you can solve for in the next 5 to 7 years. Right? This is the time. This is what we are at the cusp of, right? So the prize is very, very big, and the prize is not like, hey, 2 generations later. Yeah. This is like technology is moving so fast that we're talking about 5 to 7 years, in the worst case, 10 years. But it's one of the core infrastructure points that we have to solve.
Samir?
So I think Madhur nailed a bunch of points. I think there are areas where at almost societal level, we need policy to really kick in. DND is clearly not working the way it was intended. I think we are not the first industry to complain about that. It has been the bane of existence for a bunch of them. But yes, I think the stakes are much higher when you're talking about people's entire salaries getting wiped out or income getting wiped out. I'll actually say this. I think props to Paytm. We joined later once we heard about the announcement, but I think it's pretty bold and unpopular, as Madhur said, to go out there and challenge all the telecom operators on this one. I'm glad they did it. Thank you. We joined as soon as we heard, but I think there are a bunch more such things that the industry should rally around. We did join UPI when they'd done a sort of education campaign. But again, that was on Twitter, that's on social media, that's on digital. And the problem with some of these things is, I think those ads are going to people who are already careful or have already heard of two-factor authentication and have already heard of these things. We need a purposeful intercept where audiences are engaged. And I think I've seen some interesting ads during KBC where Amitabh Bachchan's talking on behalf of RBI. Those are forced interventions, they're unpopular interventions, but they work. I'd love to see some more during IPL. We ran a few with the government recently. But again, I'm not sure that they're going necessarily to the startup that really needs them, new to internet, not just new to payments, but new to internet. But I think there's another problem, and I think it's pretty specific to developing markets, and India is one of them, which is law enforcement, right? There has to be a chilling factor if you're caught operating a racket. I'm not talking about just one willful fraud, some nephew sort of scamming their uncle. I'm talking about entire villages with hundreds of SIM cards running a proper sort of cybercrime racket. And I think here there have been investigations in the past. There have been takedowns. We've helped break down rackets like this as well in various states: Jharkhand, Orissa, West Bengal. My problem is you could have 200-300 people wipe out thousands of accounts, and ultimately the entire penalty comes down to maybe 6 months. 4 jobless kids who basically have nothing to lose going to jail for 6 months, and maybe 1 or 2 or 5 lakhs penalty. That is just like, the punishment is not proportionate to the crime, right? And I think that's a real problem. And by the way, that's one of the reasons why, like, Samita, you and I have spoken for several years about why PhonePe, for example, doesn't enter lending. I don't think it has anything to do with product innovation. If product innovation could solve lending in India, I'd enter yesterday. In a market like India, when there's willful defaulters, especially if you go fully digital and there's no face-to-face, this is that one market where if I don't know the customer, people will scam you all day long because, again, it's free money. Once I have the money, there's not enough jails to arrest people who are willful defaulters. We really need to figure out what the new normal is going to look like, because in a fully digitized world where all the money is moving digitally, lending may still not open up. And I think that's when the regulator and the government start looking at this and saying, we need to introduce stricter punishment for people who are deliberately like introducing cybercrime.
Lizzie, I think you can talk about it, and so can Rajiv, on the lending and the credit part, and how difficult it is, especially for you. Like Samir mentioned, I mean, there is not much in terms of physical interface.
Yeah, I mean, we don't get as exposed as cash lenders do. Obviously, for a fraudster, cash is always more exciting than, an e-commerce package that they have to resell. And we do have very sophisticated anti-fraud technology that we developed in our previous life over like 10 years. So we're in a good zone. But what we've seen in our industry, and exactly like the UPI guys are seeing, is a rise of effectively cybercrime. So as soon as a body of products gets popular, versions of that, hacked versions, will emerge, right? And there are probably some 200-300 completely fake lending apps in the App Store right now. And as a lending association, we put together a group of, the good guys, people like us that want to clean and help and educate customers, the Digital Lending Association. And we've been really, really active in creating, education, very good fair practices, codes of conducts to help customers decide what is a real lending business and what is a completely fake app. Unfortunately, exactly as Samir says, the challenge is that there isn't any kind of cleanup mechanism that we can rely on. We can't depend on Google, we can't depend on the App Store to do its own self-regulation. And many of these apps are not actually, clearly, obviously breaking a law. They don't claim to be, right? It's very difficult. It's very tangential. It's a very much a sort of gray area loophole that they're exploiting. But this is a really, really big issue for us right now. A lot of us are focused on this because what we believe is if we lose customer trust at this point, at so early in the cycle, so early in the credit cycle, it's going to be really hard to get that back. And so exactly as Samir said, it's about collaboration and it's about everybody working together and having the same messages and the same education to their consumers so that we just progressively, over time heighten the awareness. But it is, it's a huge, huge problem right now. And maybe we even need to come together across industry, banks, UPI apps and lenders working together on this topic.
Yeah, I'll just add a little bit to what Samir was saying. I think ads literacy is all very good. We also have to do a lot of this in person, which I know for many of you is a little bit challenge. So one of the biggest objectives of our branches is to actually reach out to customers of all segments to actually educate them. And it's still quite interesting that 7 or 8 out of 10 problems which happen is plain old password or PIN, accidentally, or hey, I'll just give it to my office person or my relative. I mean, those are the kinds of issues which are there. So it's, there are those which are very, very well planned, but 8 out of 10 is still this old-fashioned password sharing. You have to do a lot more, various ways of doing it. And I think on the lending side, we actually have the same view as Samir does that any form of lending of a certain size and to a new person better be done in person first, or at least have somewhere that you or your partner can actually physically meet the person, and get some sort of a buy-in, because, there are challenges of being totally blind in terms of lending. Yes, our own customers who've been with us in various forms, we are quite open, and that's a matter of how our risk appetite relative to, our understanding of their data, their credit functions. Obviously, when we work with partners, we rely a lot on our partners as well to provide us that background data and then take our credit call. It's an evolving, paradigm. I don't think it's perfect. So far, I can only say that on the consumer side or the financial inclusion side, actually has been far better experience than on the corporate side. So I would say that, in fact, we do a lot of business in financial inclusion where, it's all done in person, and we've never had an issue because there's a lot of social and moral conviction attached to lending there, and that works very well in spite of the challenges there. I think these things will evolve. I don't think we can go back to the whole environment where everything was done in person, or we can be lending large sums of money without meeting the person. I think the relevance which people place on their CIBIL score is still evolving. And I'm pretty mindful that the last 6-9 months, many people would have gotten their CIBIL scores compromised because of excessive borrowing, and they don't care yet. Okay, maybe 2 years from now, they'll start caring because, but right now, in a sense of where the environment is, they'd rather just go and borrow as much money as they want and not return. So it's a social issue as well, more than just a technology issue.
I'm going to end this session, but one quick take from all of you in terms of, what do you think each one of you would be the most sort of critical and sort of key development that all of us should be watching out for in terms of the next year, 2021, in the overall, fintech and digital banking and financial services space. If each one of you give me that one thing to look out for. Lizzie, you want to take it first?
I'm so biased, obviously. I'll say contextual credit. I think this is going to be the year of what we call contextual credit, basically finally breaking down credit into where it's needed and delivering it alongside transactions rather than, forcing people to go through lengthy and very heavy credit application processes. So 2021, watch out for that.
Madhur?
Listen, it's hard to say because there's so many different moving parts, right? We have just on this call, we have discussed, competition, regulation, consumer protection, and so on.
You can tell me how WhatsApp Pay would challenge all the incumbents.
Well, it's impossible to say, right? It's impossible to say. I'm sure if they build a decent product, they'll have some customers. Will it expand the market? Will it take share from other markets? Presumably, a lot of what they will do initially, whatever they're doing, some large share of that will be P2P and stuff. But it's hard to say. You just don't know, right? I think the important thing is over the next 2 to 3 years, you will see fintech scale, but not just scale in size, but also in terms of scope. We're not in the same camp, like Samir was saying, with respect to lending and so on. We do think that in the next 12 months, at least, our journey is to be more of a super app on both consumer internet as well as financial services. A lot of the things that we have piloted over the last, some are pilots and some are sort of beyond pilot over the last 12 to 18 months, whether it's in lending or mutual fund distribution, equity trading, insurance distribution. A lot of them are very promising. So I think both on consumer, so we think about 3 parts of the ecosystem. One is consumer internet, the second is financial services, the third is merchant services. These are 3 layers that we build on top of payments. You'll see all of them become broader, and I think you'll see a lot of these things starting to come together, right? And I think the key thing is to give great products and technology to both consumers and merchants, and then they will have their own usages, right? They'll have their own patterns about how to take those great products and technologies and make them their own, whether it's devices or sound boxes that we do in the offline world, or it is payment gateway services that we provide to online partners, or whether it is how our UPI is integrated with our payments bank. All of these things sort of go out there and then consumers sort of adopt them as their own. We're pretty excited about 2021, right? COVID or no COVID.
Samir, what's the one game-changing thing that we should be looking out for? Please do not talk about your business.
No, not my business per se. I just because of a bunch of signals, I think 21 is where the regulator does open up banking and tech meets banking for the first time. We've been talking about neobanking for 4 or 5 years. We've been talking about all the pieces of banking piecemeal have opened up as licenses over the last decade. But somehow there's something about a bank, maybe it's the governance, maybe it's the fact that it's the sum of the parts, that makes it the most sort of precious business model that tech is looking at for the last 5 years. Something tells me something gives next year. I can't say what, but I have a feeling tech meets banking next year in a very different way, and life will never be the same. And I think that might be what is required for lending and everything else to open up. So that's the fintech part. I'll make a random and bold prediction. I think if the vaccine hits the population by the summer, I think by the end of next year, we will start seeing the decline of social media and permanently it will last. I think human beings have saturated their brains with irrelevant tweets and unuseful communication sitting in the households for a lifetime. And I think we will revert back to more meaningful, hopefully useful information exchange, and then chat with our loved ones as much as we need to. And I think social media is dead. I'm waiting for that day.
Wow.
Hurrah.
The long newspaper.
Can't wait. Yay.
All right.
Perfect entry for me. So
Rajiv, it's a tough one now for you to talk.
No. So I'm very clear. I think Samir will have to eat his words on social media next year, and I hope the vaccine comes. I'm a big believer in human psychology, crowd psychology, that we'll find some other purpose for social media, which is as challenging as we have. But look, I think broadly what I'd like to see is that one very important startup on the last 10 years list itself in India. If we can achieve that, I think giving legitimacy to the efforts of so many people here, so much of good creative work happening. If we can have in any sector, so I'm not saying just in financial services, it would be lovely if we have in financial services, but if one big startup were to list, I think that'll bring out many things, that actually it's possible to build businesses from the ground up without any promoter backing, being funded with professional capital, professionally managed, and yet find scale and eventually returns, cash flow returns. Because I think it also have a reverse feedback impact on new fundings, both in the startup world, Series A, Series B. I just wish it happens because India, one of the things which hasn't happened is exits of a meaningful sort over the last 7-8 years. And I do think the industry definitely needs, whether it's in food tech, edge tech, ed tech, or fintech, wherever you think it's most appropriate. So I'm hoping for that. I think the financial services side, I do think that maybe not next year, because I think in some manner, fintech is still a very, very nice word. And even the bankers want to be called fintech, but the words of fintech and banking will converge because we will become more fintech. And as Samir, fintechs will want to become more like banks. So I think that, hopefully should happen in India far faster, in my view, because we have a smart set of people all around.
He was suddenly talking like an investor when he was complaining about the lack of exits. But a lot of expectations now from the three of you to start planning your IPOs. But thanks a lot, all the four of you. Amazing conversation, so many insights. Thanks a lot for taking out time. Samir, Madhur, Lizzie, Rajiv. Hope you had an interesting, chat, and hopefully we should be doing more of this in the future. Thanks a lot for joining in, all of you.
Thank you.
Thank you.
Thank you
Great
so
fun.
much.